Welcome back to MPC Africa's special coverage of the Monetary Policy Committee decision, which this time around went just as expected. The Central Bank's Monetary Policy Committee holding rates at 12%, plus or minus 2%. That interest rate corridor remaining the same. They also left the cash reserve ratio at 12%, and they also left the net open position limit for banks in the FX market at 1%. Joining us for some analysis on this decision is Sola Adegbesan. He's Head of Global Market Sales at Stanbic IBTC, joining us in the studio. And standing by at UBA is Kubi Momoh, Head of Market Risk at UBA. Sola, let me start with you. First of all, I think it went as expected. Many people thought we'll probably see this scenario, no change on all fronts. But was there anything you thought the central bank could have tweaked or should have tweaked?
No, I don't think there was much they could do. I think it was more of a situation where there was very little more that they could do than any other surprises. As is, they had two scenarios. It was either upwards or downwards. There was very, very little chance of them taking the rates up again, considering the strain on liquidity that we saw after the last MPC. And also, surprisingly, they had a good grasp of some of the policy measures that were taken in the United States, which would have an indirect impact on liquidity in Nigeria. So I think it was expected, and I think they just did what was expected on the basis of they were in a semi-tight corner.
Right. Kubi, let me get your thoughts on this. I think, like you said, widely expected. Nobody thought they would change much. But I think very interesting state data coming out from the central bank. $3 billion is the amount that has come into the system in August. Clearly, we've seen huge inflows into Nigeria's debt market after the JP Morgan addition of Nigerian bonds to their emerging market index. But your thoughts on the exchange rate policy decision? Do you think they should have changed anything there?
Well, the banks might have wanted to see a slight change there in terms of the fact that the NOP is pretty restrictive at 1%.
Right.
But again, like you said, the central bank needs to keep an eye on what we call the hot flows into the system, because they have a way of reversing, and when they do, that tends to give a kind of shock. So yes, they've kept up with the restrictive policies. Again, maybe some people might have wanted to see an easing of the cash reserve ratio, which is the CRR, which was adjusted to 12% at the last meeting. But other than that, the policies seem to have worked. If you look at what the central bank had said at the beginning of the year they want to achieve, they want a stable exchange rate and interest rates, well, maybe higher than inflation at least. They've succeeded with that. They've been able to accumulate reserves. Again, at some point, we are going to see some of those foreign flows going out. So we need to have sufficient buffer, one, for the imports, and two, for a reversal of the investments. So I think they're pretty much on track. It's much as what we had expected. If anybody had thought anything would change, maybe the cash reserve ratio might have changed a bit, but overall, it's pretty much what the market thought it would be.
Shola, any thoughts on the exchange rate policy?
Well, I wouldn't be in a hurry to complain about the NOP, in the sense that my view is that banks should be looking towards an appreciating currency rather than a depreciating currency. I think there's a bit of a misgiving around the foreign inflows in the market, but one thing people should realize is that the inflows that are coming in now are a bit different from what we've seen in the past. In the past, it was largely hedge funds and speculative plays.
Yeah.
Right now, the implication of the index is that it makes Nigeria a globally acceptable investment destination for portfolio investors, which then means what you'd start to see is real money funds. And real money funds
institutional money for long term.
Pension funds long term. They're not looking for the 3 months, 6 months carry trade. Yes, you still have some of those hedge funds doing that, but a large part of what we've seen in the recent times are real money funds, and they're in it for the long haul. I think it's more of for us as a country to keep our country, to keep telling a good story about the country. It's only a fundamental issue with the country that would get these guys to start looking to take their money elsewhere, rather than a 6-month play on a carry trade.
All right, let me come back to you, Kubi, and let's talk about the outlook for inflation. I think right now the central bank is in line with what some analysts in the market are thinking, that we may see a single-digit inflation sometime at some point this year. I think at the last MPC, they were thinking 12% was the likely average for the next 6 months. I think they're probably taking that a little lower now. What would be the impact on bond yields in your view? I was speaking to somebody earlier. Could we possibly see, for instance, bond yields coming to single digits?
Well, as it is, bond yields have gone down significantly from the amount of investment that have flowed to them. And I think what has had more of an impact on bond yields has been the amount of liquidity in the system or the amount of demand. They've tended to respond more to demand pressures than to inflationary pressures.
Right.
For a very long time, I mean, if you look back a couple of years, maybe 3 years, you'd have seen that the bond yields were actually lower than inflation. So that might not be a direct driver. That tends to respond more to demand and supply. So maybe not directly, but in terms of where we see inflation going, yes, inflation has trended pretty much. I'm sure with these numbers, 11.7, that's the lowest we've had in about maybe 4 to 6 months. So it's heading in the right direction. Single digits, I'm not sure we'll see single digits in 2012. Maybe into 2013, we might start to see that, but I don't see that happening before the end of this year.
Sola, your thoughts on the demand we may see towards our bond market, especially from foreign portfolio investors? We've seen huge demand over the last few months. After this decision, what do you think we'll see going forward?
I think what this decision just did is it sort of pronounces the stability that our markets have seen in terms of monetary policy. Like I'd said previously, the difference between a hedge fund investment and real money fund investment is that the real money funds accrue funds. So basically, it's a more continuous flow of investment. I do think that the demand will continue. Proviso being the country remains attractive to investment. And I think that was one of the considerations the central bank must have had, in the sense that if they did continue tightening, it would make our bonds far more attractive for the offshore investors, and that might create a negative effect on what their intentions are. So it kept them in a situation where they were better off just keeping things as is. Yes, I do think the yields will drop, and as these funds continue to come in, and I think market players have begun to see that, unlike in the past where the funds come in, then it's a wait and see game. When the yields come, they go out. It's a constant inflow of funds which are coming in at every single auction.
All right, Kubi, I want to bring you in here. Your thoughts on the tone of the central bank's decision? Clearly, the exchange rate has been a big focus for the central bank and the Monetary Policy Committee. Yeah. More so when you consider the impact it has on the economy and imported inflation and stuff like that. Your thoughts on the tone? I think over the last few months, one has gotten the impression that that exchange rate is something that the central bank is very, very, very determined to keep stable.
Yes, and I think that trend continues. Again, it's more around stability. You know, if you look at the demand and supply pressures, or maybe should I say a reduced supply, we haven't seen that, sorry, a reduced demand. We haven't seen as heavy demand in 2012 as we've seen in 2011. If you look at the figures year on year, 2012 seems to be a bit softer year to date. And in fact, the amount on offer, a lot of times last year, CBN would be offering up to $400 million at each session. This year, we're seeing 180 million, we're seeing 250 million. We're seeing the effect of reforms in other sectors coming through to the demand and supply windows. So if the idea was to strengthen the currency significantly, I think central bank could have done that. Our reserves kind of support it. The parallel market is at convergence, and the parallel market usually takes some kind of direction from the central bank, even when there's a gap. So if you look at that, it shows that they are more interested in stability. The Naira has been stable. If 155 is the midpoint, they say they want plus or minus 3% around that. That's where we've been. Yes, we see some appreciation, but it's mild. One of the things we don't want to see is a severe devaluation. So even when we've had that, it's also been mild. But for this quarter, or for the last 2 months, generally the Naira has appreciated across all the sectors. And I think that's a sign of a very successful strategy. And they're probably going to continue with it. They've defended the Naira successfully. Reserves have grown. The macroeconomic variables have supported it. And I think they've done pretty well on that.
Sola, I think a lot of market watchers heave a sigh of relief that there was no major surprise this time. I think the last time around, there was a massive gasp. I heard that happened in some banking halls when they decided to tighten with such aggression the last time. Well, your thoughts on how rates have moved since then? Clearly, the a few days, or should I say, in fact, more like days after the decision the last time, we saw massive volatility in interbank rates. But we haven't seen that volatility sustained. In fact, what we've seen is that they've been fairly stable over the recent weeks. What has changed? What dynamic is the market missing here?
I think it's the benchmark that has changed. Now, the two things had happened after the MPC. One, there was the mop-up of liquidity, and then there was the high yield on government securities risk-free rate, which generally most depositors used as benchmark for the rates they wanted to get on their deposits. Now, with the offshore inflows coming in, we've seen a significant drop on government security rates, which does then mean the benchmark for deposits has started to drop. And I wouldn't say the liquidity situation has changed, but what I'd say is that the pricing of the liquidity has changed based on the drop in government security yields.
I think to some extent, maybe the inflows we've seen from foreign investors must have had an impact as well.
Yes, that has a direct impact, because to some extent what it means is that as these funds come in, it reduces the amount of investable securities for the domestic funds as well, which also means that there's more liquidity to put in other instruments as well.
Well, fortunately, no surprise this time, I think. I think the market is happy with this result. Thank you, Sola, for joining us. Thank you, Kubi Momoh, Head of Market Risk, reaching us from UBA, giving us her perspective as well.